Bond markets are essential in any economy. Besides offering opportunities for companies and the government to secure money to finance projects, it is also useful in attracting stock investors. Today, we'll be talking about how bond markets can attract stock investors. What are bond markets, and how are they essential in an economy? Most importantly, how can these markets attract stock investors? Well, stick around till the end as we answer these questions and more as we delve into the intricacies surrounding bond markets and stock investors. Without further ado, let us begin. First things first, what are bond markets and how are they essential to the economy? After we have understood the functioning of the market, then we will discuss the crux of today's video. How can bond markets attract stock investors? The bond market is an essential component of the functioning of our economy. In fact, it is more significant than the stock market. In 2016, the stock market in the United States only had $29 trillion in outstanding investments, whereas the bond market in the United States had approximately $39 trillion. The bond market is comprised of several issuers that are wanting to borrow money from investors. These issuers include the federal government, various municipalities, and companies. These issuers use the money that they have borrowed for a variety of purposes. It is possible that the federal government will utilize these funds to make payments under Social Security or to finance the construction of infrastructure, such as roads. It's possible for a municipality, like a city or a town, to sell multiple bonds and then put the proceeds toward funding local initiatives like constructing a new airport or schools. Bonds can also be used by corporations for the same purpose, which is to fund various projects. For instance, a technology company could invest the funds in the construction of a brand new plant to manufacture the newest and most popular electronic device. It's possible that recent developments will have a beneficial effect on the economy as a whole. The new factory will result in the creation of new jobs. The factory workers would then receive a payment, which they could either spend or put toward future purchases. In either case, they are contributing to the growth of the economy. Transactions similar to these take place on a daily basis. It begins a cycle that is beneficial to the economy as a whole. Everything kicks out with a bond transaction that takes place between an issuer and an investor. This transaction assists the issuer in raising money to finance projects, while also providing the investor with a reward in the form of interest on the cash that they have invested. Now that you have understood the idea behind bond markets, let us discuss the matter at hand. What attracts stock investors to bond markets? Why do they opt for bonds over stocks? To better understand, we will need to learn the difference between the two markets and why a stock investor might want to opt for the bond market. Let us discuss this in depth now. When it comes down to it, the main distinction between bonds and stocks can be summed up with a single comparison: debt versus equity. While stocks indicate ownership of equity in a company, bonds are debt obligations. This distinction gets us to the first significant benefit of bonds, which is as follows. Generally speaking, investing in debt is considered to be a more secure option than investing in a stock. This is because debt holders have priority over shareholders. For instance, if a firm declares bankruptcy, debt holders move to the front of the line to be paid before shareholders do. Depending on the value of the assets that are liquidated by the insolvent company, creditors might obtain at least some of the money that they originally loaned the company back, in this worst-case scenario, but shareholders might lose their whole investment. Moreover, while bonds can be risk-free investments, stocks are never risk-free investments. Additionally, there are times in people's lives when they require a level of stability and consistency. People in retirement, for example, frequently rely on the consistent income that bonds provide. It would be very disheartening to retire 2 years into a bear market if your only investment was in equities. especially if your portfolio consisted entirely of stocks. The amount of income that retirees will have during their later years can be estimated with a greater degree of confidence if they possess bonds during their later years. An investor who has a long way to go before reaching retirement age has plenty of time to make up for losses sustained as a result of periods in which equity prices fell. You have now seen the many ways that a stock investor can be attracted to a bond market. As you can see, this is mainly due to its advantages over stocks. However, this does not present the full picture. To better understand the query at hand, we also need to look at it from another perspective. If bonds were so much better, then stocks would be rendered useless in terms of investments. That cannot happen now, can it? Stocks also have their advantages. In the long run, the performance of stocks will be superior to that of bonds. However, there are points in the economic cycle where bond returns are higher than stock returns. When a recession hits, it's not unusual for stock prices to fall by more than 10% in a single year. Hence, having a component of your portfolio comprised of bonds can help smooth out the bumps that come along with it. We have discussed in depth why both of these markets are good. Let us talk about how secure they are. In terms of security, bonds issued by any government, for example, the United States government, are known as treasury bonds, and they are regarded as risk-free investments. A bond issued by a reliable government is your best chance, despite the fact that it does not generate very large yields. This is because such bonds do not take inflation into account and instead focus on preserving capital in nominal terms. If the preservation of your capital is your primary objective, then purchasing bonds issued by established governments is your best option. However, a bond is not your best option every single time. Sometimes it can be more of a menace than a better option. It's important to remember that despite the fact that bonds are safer, on average, this does not indicate that they are risk-free in every situation. There is another type of bond that is known as junk bonds, and they are extremely risky. What are junk bonds, you might ask? Well, junk bonds are high-risk investments that have higher default rates but offer much larger returns. These bonds are also known as high-yield bonds. In contrast to bonds with a lower level of risk and investment grade, junk bonds are not generally considered to be an excellent choice for long-term investments. If an investor is not diligent, she may end up losing money by purchasing rubbish bonds. We have now discussed the many advantages and disadvantages of stocks and bonds. While it can be argued both of them are better than the other, it is pretty obvious that stock investors can be attracted to either bond markets or stock markets. It depends on various factors, such as the type of bond and stock, the time period the investor might seek to enter the market, etc. In the end, I will just say that bonds are an investment that are known for their safety and conservatism. As a result, they are able to give any diversified portfolio a sense of composure and security. They are an excellent savings vehicle for times when you don't want to put your money at risk, and they guarantee a certain stream of income even when the stock market is performing poorly. Thus, do invest in them if you want relatively risk-free returns. If you want risky but high returns, the stock market awaits you. It all depends on your choice and preference. This is a wrap on this video. Hope you liked it, and if you did, make sure you press the like button. If you haven't subscribed already, make sure to subscribe to our channel. Do let us know any more topics that you would like to see videos on. Till then, see ya.